Are your trading backtests bringing you down? I'm champion trader Kevin Davey, and here's 5 ways to make your backtests more accurate. Let's jump into some great education. We're going to talk about backtests. Great backtests, but terrible real-time results. Why? There's a bunch of different ways, a bunch of different reasons. I'm only going to talk about 5 of them today, but these are what I would consider 5 backbreakers. I mean, just things that will kill your real-time results. Okay? All right. So let's take a look at backbreaker number 1. Backtest backbreaker. I thought that sounded neat. So, and what it means is it just kills your real-time performance if you do it. And the first one you've probably heard me talk about before, ignoring slippage and commission. So many people neglect this. It's ridiculous. And okay, there's a time and a place where you can kind of ignore slippage and commission when you're doing some initial studies maybe. And I've seen people do that. But as soon as you have a strategy that you really want to backtest, so you know your entries, you know your exits, and you have all that, you have to include slippage and commission. I'll show you an example why it matters. This is a coffee strategy. And you can look at it and say, it looks all right, you know, over what, 750 or so tests or trades. It makes about $70,000. So roughly $100 per trade. Not bad. You could say, hey, this could be a pretty good system. Yeah, there's some long-term drawdowns, but you know, I might be able to live with that. But the big thing is it has no slippage and no commission. So what happens when you add that to this strategy? Well, nothing good. I can tell you that. In this particular case, your profit is reduced by like 75%. And now I cheated a little bit because I took coffee, because coffee has high slippage. Coffee's not a market where you can just get in at your price, or you know, you send a market order, there's going to be some slippage because it's just not as heavily traded as something like the ES. But the point is, if you leave it out, you're going to get dramatically different results than when you put it in. And that's why this is important. And it isn't just the net profit that's an issue. And you might say, well, why? Because the net profit, you know, the slippage and commission come right off the net profit. That's true, but there's a lot more to it. When you neglect slippage and commission, your drawdowns, they're going to be a lot longer, a lot deeper than you would have believed. If you want to try a reverse system, a lot of people love this. When their equity curve is going the wrong way, they just say, hey, reverse it. It'll work great. Well, that almost never works because of slippage and commission. Slippage and commission work both ways, right? They hurt you when you're going one direction. If you did the reverse, they'd hurt you on the reverse. A lot of people don't realize that right off the bat. And then the third thing is when you go to optimize, when you don't have trading costs, the optimizer is going to try to maximize, let's say, net profit, and it's going to lead you to take more trades. And I'll show an example of that. So that's a biggie. A lot of people don't even think about that, but it forces you to trade more often when there's no slippage and commission. Why not, right? There's no trading costs. You want to trade as much as possible. But as soon as you put those costs in there, then you got to watch out. So here's a simple question. What is better? And I won't put a poll on it, but Okay, you have option A. You trade one trade per week. You average $200 per trade. Okay. Or you have system B that trades 100 times per week, only makes $5 per trade, but it makes $500 a week. Okay. So what's better without slippage and commission? Okay. That's why I didn't ask this, because this is an easy answer. Of course, case B is better. You got a lot more profit, probably less drawdown, and you got a whole bunch more trades. So if you think of statistical significance with, hey, I want a whole bunch of trades, this looks great. Well, now take the same case and let's add $25 slippage and commission, which is a pretty reasonable value. Well, now your option A only makes 175 bucks, but your option B is what really gets in trouble. Now your $500 gain actually turns into a $2,000 loss. So again, I'll ask you, which is better? Well, now case B is undoubtedly worse. And that's the effect of slippage and commission. So not only does it reduce your profit, it could lead you down a path when you optimize or decide on which case you're going to, which strategy you're going to trade. It could really, really hurt you. So just keep that in mind. And for people who are asking questions, I'm going to try to get to questions at the end because I want to kind of get through it, and we'll have plenty of time for questions at the end. So you can feel free to type them in at any time. I'll go in order, but I probably won't answer them until the end. So how do you fix this? Backbreaker number one, always include slippage and commission. And if you don't know what to use, hey, maybe you try a few live trades to estimate it. That's one way to do it. For students who take my workshop, what I actually do is I provide them with slippage numbers for just about any futures market, and it's based on my real trading, input from other students, and I've run some detailed bid-ask analysis studies, with hundreds of thousands of data points to see, hey, what's a reasonable slippage to use? And we tend to be a little conservative, but that's actually a good thing to do that. So that's how you fix that first backbreaker. Make sure you include slippage and commission. So let's talk about backbreaker number two. And that one is not employing look inside bar backtesting. Now that's what TradeStation calls it. Other platforms will call it something different. Either Ninja or Multicharts calls it bar magnifier. I'll explain it. It's the same principle for all these platforms, but it's a huge deal. And I'll give you an example. Here's a breakout code, no optimizing. Hey, it looks pretty decent. You might say, hey, that looks good. I like it. But can you believe it? Well, in TradeStation, all you have to do is click one little checkbox. It says use look inside bar backtesting at a 1 minute resolution. And that's what happens. So the results went from really pretty good to horrible. And you might say, well, how do I know which one's real? Which one's the truth and which one's fake? And as you can probably guess, when you see something like this, it's always better to put your faith in the worst one, right? It's better to be pessimistic with some of these things than to be optimistic. But the second one's right, and I'm going to explain it why it's that way. So let's just say you were going short, okay? And you enter at the open. So, this green bar is your open, your low, your high, and your close, okay? It's simple. And it really doesn't matter what size. This could be a daily bar, it could be a 60-minute bar. It's just a bar. So you go short, and then you set your profit target to get a reasonable profit. You set your stop loss, and both of them could have been hit on this particular bar. Of course, you didn't know that when you placed the trade. You just placed your profit target and your stop loss. Which one gets hit first? Well, if the trading platform, if all it knew was the open, high, low, and close, which is what it normally knows, it would have to make some assumptions. And I won't go into what exactly it does because it'll just sound crazy. But in this case, what it assumes, the backtest engine would assume it would go down to the low, and that would hit your profit target. Then it would go up to the high, and then it would come back down to the close. So your profit target would be hit. Then, of course, your stop loss disappears because you're out of the trade. So overall, hey, the backtest tells you, hey, this is a profitable trade. Nice job. But what if this happened? Where the price went up immediately, hit your stop loss, then it went down, and then it went back up to close at that green one. And you might say, oh, that'll never happen. Happens all the time. And if this is what actually happened, this is a losing trade, right? And when you think about the effect on a backtest, one trade, not only did you not win, but you also lost. It's a double swing, right? If you were going for $100 profit target or a $200 stop loss, you thought you made $100. Well, no, you actually lost $200. So the difference in the back test is pretty significant. And that's why you need look inside bar back testing. Luckily, with most software, it's built in. So you don't have to really think about it. You just check that little box. But it's important that you do if you need it. Now, you don't need it for all back tests, and that's where people get messed up. So for example, if I didn't have a profit target here, if I just had a stop loss, I wouldn't necessarily need look inside bar back testing because my goal here would be to keep going in the trade, right? But no, that bar I get stopped out. So you don't need look inside bar back testing for that. But if your profit target and your stop loss can both be hit on the same bar, you do need it. So what I recommend to fix this problem, use 1 minute look inside bar back testing. Yeah, it's going to take a little longer to run your tests, but you get better accuracy. And if you're unsure if you need it, well, run a few tests, try it with it on and off and see what happens. It'll be pretty clear. And this becomes an even bigger problem when you start testing scalping strategies. I'm not a fan of scalping strategies at all because usually scalping strategies are the good thing, or the only thing about that is you're the one getting scalped. You're not scalping the market's scalping you. If you don't believe that, send me an email. We can talk about that because scalping is pretty dangerous. And if you try scalping and back testing, you're liable to get some unrealistic results. I go down to 1 minute because then I can test for the last 10 or 15 years, but you might need to get down to the tick level, which for that, you only can have 6 months of data normally. Okay, so the way I fix it for, I have a club that is for people who attend my workshop. I review every strategy it's submitted and I run it with 1 minute look inside bar back testing, and I make sure the results are accurate. So every once in a while somebody submits a great looking strategy and it turns out they forgot to have 1 minute look inside bar back testing because it almost always makes your results look better. So that's how you fix number 2. Moving on, we're going to go to backbreaker number 3, and that's too short of a back test. So what does that mean? Well, I see these all the time on trading forums where somebody says, hey, look at my back test, it looks great. Well, they tested for a year here. And you can't deny it's a nice looking back test. 35 trades in a year. Okay, once a week trading. Hey, it looks pretty good. But now the problem with it when you run a real short back test is you can have all these issues that are just under the surface that you don't know about because you only tested for a year. You know, maybe you over optimized for that 1 year. Maybe there were tons of rules and tons of inputs. You don't know. And, you know, maybe you did something like only took long trades in a bull market. You know, I see that all the time, especially with stock strategies. Well, yeah, the stock market's been going up for how many years? Of course, that's going to happen. So you don't know what's involved with it unless you do a longer test. And that, you know, all those things could kind of add in. So let's do a longer test here. Now, what you saw in the last one is probably the last 50 trades or so, and that looks great. But take it back 10 years, and all of a sudden, it does okay, and then it's down, 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 and then all of a sudden it jumps up again. That's not as nice of a back test. I mean, just imagine yourself, if you think this is a good, something worth trading, imagine yourself starting to trade it right here. You know, you have to go how many years before things really take off. So it's not that good. So doing too short of a back test is a killer. And a lot of people fall for it. And, you know, part of the reason is it's so much easier to create back tests with a small amount of data, right? I mean, your own experience, I'm sure, is telling you that, hey, if I test over 3 months of data, I can create a great test. But if I do it over 3 years of data, it's a lot harder. And that's what a short back test does to you. It just makes it so the less data you have less market conditions. You have less bull markets, bear markets, volatile markets, flat markets. And the whole idea with back testing is you want to test as many of those different kind of scenarios as you can and see how your strategy does. What it comes down to is the more data you have and the more data you test with, the better off you're going to be. Pretty simple. So how do you fix this? Make sure you have a long enough duration in your back test. And since short back tests are easier to curve fit, limiting optimization helps. So, you know, longer back tests, less optimization will help you with this. And for students of my workshop, I actually provide them with, hey, don't use more than this many inputs to optimize. Try to go for this many trades and try to start testing on this date. Because those are things I've used in my own trading that have worked pretty well. So I don't want to confuse you by saying, hey, you never run a 3-month back test because they'll never work. Sometimes they will work, but over the long haul of doing a lot of strategies, it's better to have a longer back test and less optimization. So that's how you can fix that. And let's go on to our last two. Backtest, backbreaker number 4, limit order touch fills. Okay, what's that? Well, let me show you an example first. So strategy version A, it's a touch fill. So if you had a limit order, buy next bar at a certain price limit, and as soon as the market touches your price, you assume a fill. you get version A. Now, if you say, no, I'm going to wait till my price is exceeded, and that guarantees me a fill on a limit order, look at your profit goes way down. In this case, by like $50,000, so more than half. And I could show other examples of where the touch fills can actually turn a losing strategy into a winner. So assuming the fill if price exceeded, hey, it loses money, and then you turn that off and say touch fills are good, it could turn it into a winner. This is one that always gets people. And a lot of the sims out there, the simulators, a lot of them assume touch fills, which just drives me nuts. Now, it doesn't mean you'll never get filled on a touch fill, but my experience is probably about 80, it's an 80-20 type split where you put a limit order out there and the price just gets touched. About 20% of the time you will get filled. 80% of the time you won't. Now, the bad part is you're always going to get filled on losing trades, right? Because the price goes through your limit price. And it's just some of those winning trades you won't have if you assume touch fills. So this one is big. And remember I said, whenever you see two different results, always kind of favor the one that's worse. That's definitely true here. You want to use fills only if the price has been exceeded. Don't do those touch fills. And in TradeStation, it's the default is actually touch fills, which is just mind-boggling. But remember I said some of this is the trading platform trying to encourage you to get good results. And you certainly get good results with assuming touch fills. So, you just got to watch out for that and make sure it's always checked that, hey, you're only going to do if the price is exceeded. So that's how you can do it on your own. For people who take my workshop, I give them additional info about this type issue and other little issues too that are sort of related with exit functions and that kind of thing, because this can really upset your back test. So you got to watch out for that. And then the last backtest backbreaker, number 5, say that 10 times fast, is going to be not having out of sample results. Okay. Here's what your results look like during development. Looks good, right? Most people would probably be wanting to trade this if you developed a system and you had a backtest that looked like this. But if it's overfit, too many rules, too many inputs, too many optimization runs, all sorts of stuff. If you do something wrong, you get this, where it just kind of, this one didn't collapse completely like that other one I showed you, but it collapsed, it just didn't do too good in live trading. And so the key with this is you got to do out of sample testing. You can test with some data, but don't test with all the data, okay? Because if you just run an optimized backtest, this is not going to be enough. You need to have this out of sample. Now I do it with walk forward testing. And even with walk forward testing, out of sample tests are very easy to abuse. Most people abuse them. How do you abuse them? You go and you run your test, your in-sample test, you optimize it, look at the out-of-sample results, and the out-of-sample results don't look good, and then you go back and modify the system and rerun the in-sample, and then you get a different out-of-sample result. And you keep doing that until you get a good out-of-sample result. That is not the way to do it. because all you're doing is you're optimizing for out of sample, and your out of sample now isn't out of sample. So I use walk forward testing. If you don't know what that is, I have some videos on my YouTube channel about that. But basically, when you do it step by step, you actually get a whole bunch of yellow data, which is out of sample data when you do it correctly. The problem with walk forward testing is when you compare it to optimized testing or just standard 80-20 out of sample testing, it's more difficult, and it's just tougher analysis to do, but it tends to work better in real time. Now, it doesn't work as good as real time, real money. You know, you can't beat that for testing, right? That's the ultimate, but it's certainly a ton better than optimized testing, and it's a ton better than just simple out of sample testing. So that's why I use walk forward. You can use out of sample testing, but don't, whatever you do, don't use just optimized testing. You know, I'm gonna say no, don't do that. If you take away nothing else from today, just remember, don't do optimized testing alone, because there's probably a way to do it correctly, but most people can't do it correctly. And then when you do walk forward, what you end up getting are different parameters for different periods of time. And so it adjusts as you kind of go on, and it kind of is tuned to the current market. It's kind of neat. So to fix this backbreaker, you know, don't rely on in-sample results. And if you're going to do out of sample or walk forward, which you should, just be careful, because it's really easy to screw it up. And you know, for my students in my workshop, I teach them the right way to do it. I give them some tips and some, hey, don't do this, and it helps them a lot to get better walk forward results. And by better, I mean ones you can believe that could possibly work going forward. And that's what you're aiming for. So my strategy development approach eliminates these common backbreakers and many more of them, a lot of them that are out there. So you got to keep that in mind. If you avoid these 5 backbreakers, you'll get a long way towards improving your trading.
Well, I hope you liked this video. If you did, please give it a thumbs up, subscribe to my channel, and feel free, leave a comment. What backtest tricks do you know that can help other people? Leave a comment. I'll respond to all comments. Thanks for watching.